Over the years, I built a $30 million property portfolio, and I've personally been involved in over $50 million of property transactions. I'm not trying to tell you this to impress you, but I want you to genuinely see what's possible. I want you to know that if I can do it, then anyone can do it. But the truth is, achieving financial freedom does not happen by accident. In today's video, I'll share my story and the key lessons I learned along the way. The lessons that changed my life, and you can use them to change yours. Growing up, I was the eldest of 4 kids. It was a classic middle-class Australian family. Dad ran his own business, and Mum was at home juggling the kids. They both worked their guts out. They were always doing their best, but looking back, I realised it wasn't by choice. It was because they had to. We were never poor, and there was always food on the table, but money was tight. Remember the stress in their voices when the bills came in, the quiet sacrifices that they made so we never went without. There were no international holidays, there were no fancy cars, we were just getting by. No matter how hard they were working, it never felt like we could get ahead. Even as a kid, I think I absorbed that at a really deep level. Like it hardwired something in me, a belief that I didn't want to spend my life just getting by. I wanted financial independence. That mindset became the first and most important tool in my toolkit. Now that I knew that I wanted it, I just needed to figure out how to get it. But it felt so elusive, like something I could see and understand, but couldn't quite grasp. And honestly, somehow I doubted my odds of ever being able to achieve financial freedom that I so deeply wanted. I became obsessed with learning, reading every book I could get my hands on, and slowly started to piece things together. I caught on to some basic financial concepts, and for the first time I realised there was another way. One concept that completely blew my mind was the concept of compound interest. Maybe because at that stage, all I had was a bank account with a few dollars in it, talking about literally starting from zero. But it was something tangible. It was something that actually applied to me. So it caught my attention. Academically, I wasn't top of the class, coming from a really average public school. I barely scraped by with the marks to get into university and study business. But honestly, for me, the real focus wasn't on study or textbooks. It was on trying to make money. I didn't know where to go or who to talk to or what to do, so I took whatever jobs I could to try and bring in the cash. At one point, I was juggling 3 jobs whilst I was studying at uni. During the week, I worked as a greenkeeper at a golf course. Saturdays were a grind with a 12-hour shift at the supermarket, and then at night time, I deliver pizzas. Friday night and Saturday night were the best time for that. You do more deliveries and get better tips. Every dollar felt like a step closer to something bigger. Even though, like all of us, there were times where it felt like I doubted myself, where I thought it might not all be worth it, but I kept pushing forward. I stayed determined and being fueled by the little wins and signs that showed that I was on somewhat of a right path. Eventually, I landed some higher paying jobs. One of my favourites was working as a valet in the city. I was moving cars in a car park, which at the time, loving cars, I absolutely loved. Management shifted me into a car washing position, and it wasn't long before I was moved to a second site on Phillip Street where I was suddenly surrounded by exotic cars. I'll never forget the moment where I got to drive my first exotic car. It was a Ferrari 360 Spider. Beautiful, near new, silver, 6-speed manual, and it was the highlight of my life. Normally I could wash a car in about an hour, fully detail it, but I feel like this car at the time took a few hours to detail. I just wanted to soak in every second of it. Toward the end of uni, I landed a full-time role at The Good Guys. This worked perfectly around my schedule with uni, so I'd work weekends and then a few days a week. The job turned out to be a bit of a game changer for me, not just because it paid well, but because it was commission-based. So what you earned depended entirely on what you sold. While most of the guys in the store were clocking in and out, standing around, taking it easy, I saw an opportunity. While they were killing time, I was hustling. Customers were coming into the store looking for a toaster, and I'd be there trying to sell them fridges, TVs, entertainment units, absolutely everything I could find. This is where I really learnt the art of sales, how to read people, how to build trust, and how to close deals. And looking back, that changed everything for me. From there, I went even deeper, searching for books that were specific to Australian property investment. I found 2 books at the time that completely changed the game. Steve McKnight's 0 to 130 Properties and Peter Span's Wealth Magic. Both books were quite good, but quite different in their own regard. I think Peter's story really got into my subconscious. At the time of writing that book, he lived in Darling Point and he was driving a red Ferrari. Many, many years later, I found myself in that exact position. So it's funny how life works. But if there was ever really a turning point in my life, it was meeting my girlfriend at the time, who's now my wife, Melissa. We were both 20 and we were both studying and working, but she'd already bought 2 properties. I still didn't have the capital to even buy one, and so honestly, that lit a fire under me. I knew I needed to move faster, so I pulled all my money out of my little managed funds, and instead of buying my first property, took a different approach. I went into a joint venture with Mel. We were importing cars from Japan and flipping them for a profit. It wasn't traditional investing, but it was my first real taste of making money outside of the paycheck. We made a little bit of money and had a lot of fun. By the time I finished uni, I found myself stepping into a full-time PAYG job. My starting salary was a measly $36,000 per year. This was substantially less than I was getting selling kettles and fridges at The Good Guys. And as for the car business, well, that's where things took a turn and kind of went off course. We'd done well importing cars, but in the end, I was able to import the car that I really wanted. For those that know, will know, an R32 GTR Skyline. Unfortunately, that one decision wiped out any profit that we'd made. And worse still, anyone familiar with those kind of cars will be well aware that they can be a nightmare to maintain. Before I knew it, every dollar I earned had been sunk into modifications, repairs, and chasing a dream that in hindsight was a massive distraction from investing. I was off track from where I wanted to be, and I knew something needed to change. I'll never forget a conversation I had with my boss at the time. It was my second annual review, and of course, there was no pay increase. I pushed back asking why, and he gave it to me really straight, which I really appreciated. The company wasn't profitable, wasn't making any money, and couldn't afford to give staff increased wages. It was brutally honest, but I really respected that. And of course, that night, I jumped on the internet and I started researching the most profitable companies that I could find to work for. If I was going to work hard and put in effort, then I wanted to be somewhere where my performance would be rewarded. Not long after, I was able to land an interview for an entry-level sales position in a blue-chip multinational company and a prospect of a much more rewarding career. It was the night before my job interview, and I took the car out for a late night drive up the old Pacific Highway north of Sydney, just to clear my head and sort of be sharp for the next day. But of course, while I was right in the middle of that trip, enjoying the drive, the engine cut out completely and I came to a rolling stop. After spending every single dollar I had on this car, I'd blown up the engine. Sitting on the side of the freeway in the middle of the night with nobody around, I waited for hours for the tow truck to come and take me home. The car, the thing that I poured all my money into, was broken. And not just broken, but a bottomless pit. It just kept demanding more and more money. I was stuck financially, professionally, and mentally. I was stuck in a job where I wasn't making any real money. I felt completely defeated. And by the time I finally got home around 2 or 3 a.m., having an interview at 7:30 in the morning, running on no sleep, no energy, and no real plan, except one. Something had to change. I think at that point, something may have actually manifested that morning. Because despite all of that and walking into the interview feeling like I was running on the fumes that my car couldn't run on anymore, my line manager nearly hired me on the spot. And just like that, my new career path started. I didn't know it yet, but this was the moment that everything started to turn around. The move was a good one. Within 6 months of starting, I was offered a new career development opportunity interstate in Melbourne, and it was a real chance with my employer to step up with my career. It was also the forced catalyst that I needed to sell the car. I wasn't going to bring it with me. By that point, I poured another $8,000 repairing the engine from the night before the interview. I was chasing a dream with that car, but deep down, I knew it wasn't serving me. So I took the role, relocated to Melbourne, sold the car for $27,000, which was way less than I spent on it, and along with a $10,000 first home owner's grant in Victoria, whatever little savings I had at the time, started the process of buying my first property. I was 24 years old and the year was 2006. But the buying process, that was tough. I had no idea what I was doing. I didn't know what to buy, where to buy. The only thing I needed to do was make sure that it was something that I could have as a home while I was living down there and eventually turn it into an investment. I looked around the southeast suburbs of Melbourne. I tried to figure out what would make most sense for me. I must have looked at over 50 properties. At that point, I connected with a mortgage broker, but he was only really there to help arrange a loan. That was fine, but I quickly realised what was missing. I didn't have anyone with investment experience around me. I didn't have anyone that could help guide me through the process, and I didn't have anyone that could help me make a strategic decision. In the end, I settled with a 2-bedroom apartment in Richmond for $229,000. Looking back, the trade-off was clear. I could have bought a house in the southeast suburbs, which would probably have higher capital growth over the long term. But those prices were already slightly above what my budget was, and they also came with lower yields and required more maintenance. Instead, I chose what I thought was less risk. Richmond was where I wanted to live, and I knew that from a rental demand perspective, because I wanted to live there, a lot of other people would too. So it'd always be a desirable asset. And with that, I took my first steps into property investment. But it wasn't purely a lifestyle choice. I knew exactly what I was looking for in an apartment. It had to be at least 50 square meters internally. It had to have at least 2 bedrooms, giving it the flexibility to be able to be rented out room by room if you had a tenant with a flatmate. Also had to be low density, so something with minimal strata costs, something with no facilities, no lifts, no pools, no concierge, which were all expensive, and something in a small block which is solid, simple, and easy to manage. More importantly, I needed a property which I could add value to myself. It was really cost effective and required zero skill. Simple things like paint, carpet, and simple cosmetic upgrades. When I eventually moved out, I converted it to an investment property, and I was able to rent it out for $320 a week, which gave me quite a high yield of 7.2% on the purchase price. Fast forward almost 20 years later, and I've still got that asset. We've just completed a full renovation, everything from top to bottom, so we can hold it for the next 20 years. I'm expecting a decent uplift on the yield, with rent looking like it'll head to $580 per week. So the numbers. The purchase price was $229,000. Current market value would be about $500K. The gross yield on today's value is about 6%, which is a reasonable yield. But it's actually a 13% yield based on the purchase price. That first purchase opened the floodgates for me. I had momentum. So the key lesson here, if you're stuck trying to buy your first property, it might be good to follow this checklist. Choose a location with strong rental demand. So pick an area where people want to live. This will ensure your property remains desirable and tenanted long term. Stick to good fundamentals. So for instance, if you're looking at an apartment, make sure it's 50 square meters internally. You avoid lending restrictions that way. Make sure it's got at least 2 bedrooms for rental flexibility. Make sure it has low strata costs, no pools, no lifts, and no unnecessary amenities. And make sure it's a low density building, so you get better value retention that way, having one of a small block than one in a huge block. Buy something you can add value to ideally. So if you've got zero renovation skills, that's okay, but small upgrades like paint, carpet, fixtures, that can boost your rental income and your yield. And think long-term growth, not just yield. So the best investment is one that balances affordability along with a strong rental yield and potential for growth over time. If you want my full comprehensive checklist for buying your first property, then that's available for free on the link below. This is where things start to get really interesting, because now that you've got your first investment, it's about to get a lot easier. To be honest, back then, lending was a little bit more lenient. So at the time I was able to secure my second investment, which was a purchase in Queensland in 2007, with a 95% LVR plus LMI loan. This is something that not many lenders do these days, but back then the rules were a little bit different. So the rough numbers, it was a $307,000 purchase with a 5% deposit, which was 15 grand, plus 10 grand to cover the stamp duty. From there, in 2008, I had another career opportunity, which enabled me to move back to Sydney. Around the same time, Mel and I got married, so we bought our first owner-occupied property together. This was a tiny studio apartment in Eastern Sydney. It was under 30 square meters and it cost us $230,000. It was also completely unrenovated. Now, for our first joint owner-occupied property together, this wasn't what we wanted to buy. It's what we had to buy. It's what we could afford. And we knew we would use this as a starting point to build up. For this particular property, there was a really clear value add proposition. So we could do a cosmetic renovation on it. We could add in a party wall to create an effective 1-bedroom apartment, upgrade the kitchen, make it look nice. The end product was a vast improvement on what we started with. We were able to sell it in the end for $320,000, which was a solid gain for us. Over the next few years, we continued to accumulate investment properties, but it was a constant battle. We would either run out of borrowing capacity or we would run out of capital. Every time we hit a wall, we would need to do something to find a way to break through it. Sometimes that meant pushing for a promotion or even changing employers so I could increase my salary elsewhere. But in a PAYG role, it's a very hard game to play. There's only so much you can do to influence the salary that you've got, unless you're in a role that has uncapped earning potential with things like commissions. So the example of the old good guys role where you'd be selling fridges and getting 1% of sales, I guess having a good guy's role and selling fridges probably isn't going to get you to the place that you want to get to from a property investment perspective. But if you think about roles that have a high propensity of commission income, might be real estate sales, might be software sales, that's the sort of role that you can influence the outcome in terms of your performance and earn a lot more money for your servicing. There were so many times I was sitting there full of ambition, but wasn't able to execute, and it was extremely frustrating. As we kept accumulating properties, we always put a value add lens on it. Early on, we realized that we could add value in a number of different ways, whether that was renovating to sell, renovating to rent, or furnishing properties to increase the rental yield. In that example, we would spend a nominal amount on basic furnishings. So we'd trawl through Gumtree and eBay at the time, trying to find the cheapest bang for buck that we could get in terms of basic furniture. That the target market, in that instance, you'd have tourists and transient population that were looking for furnished apartments. They'd be willing to pay a premium for it. And so what you found is in an inner city apartment, you might spend $2,000 or $3,000 on basic furniture, but that'd enable you to increase the yield by $100 a week or more. That isn't a one-size-fits-all strategy, but in markets where the demand exists, it can work incredibly well. The real game changer though was getting into property development. So by 2010, we'd built a reasonable sized portfolio, we'd had success, we'd done cosmetic renovations, we'd flipped a few properties. We thought the timing was right to do our first development. Unfortunately, this actually became a cautionary tale because we made the classic mistake of jumping into development without understanding the game. We set the bar high. We went after a 4 townhouse development site in Hurstville. We bought it for $1.1 million. The existing house was in terrible condition, so it gave us a really poor rental yield whilst we organised the relevant approvals with council. But the real problem became evident. We actually had no idea what we were doing. As it turned out, neither did our architects. And unfortunately, we didn't have the experience or expertise or anybody in our team that could help point out the fact that we were on a road to disaster. After being rejected for the DA for the 3rd time, we realised that something wasn't right. At that point, we managed to find a draftsman who was very practical and he was able to amend the designs and get it pushed through council and approved really quickly. But by then, we'd burned through a couple of years, the holding costs had done us damage, and the market in Sydney was looking pretty grim. We had to make a call. So we cut our losses, we decided to sell the property, and the best that we could get for it was $1.08 million, despite the fact that we now had a DA approval on it. It was a builder that bought the project off us, and in the end he did really well. The estimated build cost was about $1 million for the project, so all up, the builder was in for about $2.23 million. At the conclusion of the project, we saw that he sold the 4 townhouses for about $2.965 million. After factoring in selling and other costs, we determined the margin for the builder that he made was about $675,000. That was a great project for him. But if we fast forward to today, there's been a recent sale in that block for $1.015 million. So the value of that site now is around $4.06 million. It reinforced a crucial lesson for us. If you can afford to hold property over time, then you can generate value, even without the need to do development. But at the time, it was truly a horrible experience. Up until that point, we'd done really well with the small scale renovation, investing in passive property, and we thought we were on the right track. But the feeling was a real feeling of hitting rock bottom. All up, we lost about $250,000 on the project. But it wasn't just that. It was also the loss that we had of the opportunity cost if we had have invested that money into other investments. But it's not about what just happens to you. It's what you take from the experience and how you react to it. So the key painful lesson that came out of here was understand the game before you play. Don't jump into property investment or property development unless you've got a good understanding of how things work. Knowing the rules, the risks, and the strategies up front can ensure that you don't have a disaster like the one that I've just gone through. On reflection now, if I had done one thing differently, I would have tried to find a mentor, somebody that could have bounced things off, somebody that could hold the mirror up and go, hey, look, I can see some issues with what you're looking to do, and maybe ask the right questions of your architect. That would have helped us mitigate the disaster and get to a better outcome and potentially some profit at the end of the day. After that disaster, instead of going back to full-blown development, we went back to basics. So what we did was buy a single residence terrace in the inner west of Sydney. We found a middle ground with this project. It wasn't a full-blown development, but it also wasn't a cosmetic renovation. What we did was a DA approval to do an extension, as well as a full renovation of the existing property. We secured DA approval for this one quite easily. We converted it from a 2-bedroom, 1-bathroom to a 3-bedroom, 2-bathroom. It was an extension upstairs for an additional bedroom and bathroom, and downstairs we did a full cosmetic renovation. We worked with the same draftsman who was able to help us with the previous development project, and off the back of that, we were able to also build a network of trades and builders who completed the works for this property. And as a result, we were fortunate enough to have a full recovery from the disaster of the previous project. The numbers on this one, the purchase price was about $725,000. The works that we did were about $250,000. We ended up selling it for $1.36 million. That left us with a net margin of $385,000, and because it was our owner-occupied residence, there was no tax associated with the profits. This strategy worked well. And so what we thought with an expanding family is that we'll upgrade to a larger terrace down the road and repeat the process again. By the end of 2014, we'd accumulated 12 properties with a rough value of $5 million. And because we'd held so many of those properties for a long period of time, the rental income had increased. So the property was positively geared, putting money in our pockets every month. And that's why as an investor, you should always start small, add value, and scale strategically. At the start, stick with low risk activities. Stick with things that can add a lot of value. So things like cosmetic renovations are low risk and has the potential to add value. When you go down the line of property development, it is high risk. And it might be really attractive to jump straight to that without knowing what you're doing, but the problem is you open yourself up to that risk. So if you can start slow and consistently and build yourself up over time, continue to reinvest the profits that you're making, then that's a much more scalable, predictable, and lower risk exercise. So at this point, we felt confident enough to step back into a full-blown development. We found a new project in the inner west. It was a duplex build, but it was a massive step up. On the numbers, it was a $2.1 million purchase. And because of where we were at with borrowing capacity, we could only fund 60% of it with a loan. So we borrowed $1.25 million. That left a shortfall of $950,000, including stamp duty, to settle the property. But on top of that, we also needed $1.1 million to build and to get the property approved. At that point, we had a really tough decision to make in order to fund the project. We decided to sell our owner-occupier home. This would free up the capital and borrowing capacity to make this project work. Thankfully, as a result of all the investing to date and the projects that we've done in recent history, we're in a really strong financial position. We were able to sell our owner-occupied home for $1.85 million, and that loan was fully offset. So that enabled us to pour all of the funds from that sale, as well as our borrowing capacity, into this project. We had a great team around us for this project. And fortunately, we were really successful with the build and we were successful with the sale. We ended up with $4.5 million from the sale of the duplexes. After accounting for all costs, including selling and holding costs, we ended up with a net profit of $1.1 million for 18 months' work with this project. At last, we'd proven to ourselves that we could actually do it, and our confidence had returned. And because development is such a capital and borrowing capacity intensive business, it had forced us into a period of what is referred to as rent vesting. For those unfamiliar with the term rent vesting, what it means is renting where you want to live and then investing your money, your capital, your borrowing capacity where it makes sense. In this instance, property development had great returns for us, so it made sense for us to allocate our money and our borrowing capacity towards property development. So to run through the numbers of this particular example with rent vesting, we'd sold our owner-occupied property for $1.85 million. If we'd kept that property, the opportunity cost with the interest rate at that time of about 4% would be around $74,000 a year, or roughly $1,400 a week. So instead, what we did with our growing family with 2 kids was decided to upgrade from a lifestyle perspective and move into a larger property with 5 bedrooms, which was valued recently at $3.3 million. So we're renting this property instead of buying it, and the rent is $1,850 per week, or roughly $96,000 a year. The opportunity cost of purchasing that $3.3 million asset would be significantly higher than that, so around $132,000 a year, or $2,500 a week. So there's a huge disparity between what we're renting it for and what it would cost to own that asset. So comparatively speaking, that's a terrible investment for the owners of that property that we were living in. For us, rent vesting made perfect sense. It allowed us to preserve our capital and our borrowing capacity and allocate it to high growth opportunities. The success of the most recent duplex project also gave us a lot of confidence, and it made me start to think about potentially pulling the pin on my career so I could go after property development full time. And that's why it's important to maximize return on capital in growth assets, not just in the family home. At this point in time, we've reached our serviceability limits. We've run out of capital, run out of borrowing capacity, we've pushed things as far as possible. So it was all about optimizing the return on capital and the return on your borrowing capacity, because all investors at some point in their journey will come across that barrier. So looking at mechanics like rent vesting might be something that's outside the box and can help you move to the next stage of investing. So at this point, we've proven to ourselves that we could do it. We could do property development consistently and do it well. We've taken on risks, we've built a portfolio, we've been successful with development. But now what? Success in property isn't all about one successful deal. It's about the continued efforts that you make over the long term and the consistency with which you invest. At that point, I'd hit a career ceiling. So for me, the more senior I got in the organisations that I was working in, the worse a fit I was for those roles. I was all about delivering results and getting the job done. But more and more those roles were around corporate politics, and that was something that I was never good at. So So with this in mind, I kept coming back to the thought of leaving and starting my own business as a mortgage broker. Something I could be responsible for, delivering results and doing what I do best all day, every day. But despite being in a position of financial strength, with near $10 million of property, including our active development projects, it still felt like a massive risk to leave my career and the stable PAYG role to go and run my own business. I'd thought about doing this since 2008, but I was afraid. The other thing was, up until this point, we were also really dependent on my PAYG salary in order to borrow money from the banks. But the game changed a little bit now. With development income, we could actually use that income for servicing with the banks, rather than just my PAYG income. So what this meant was I could confidently push out and go and do my own thing. Now, I'd always loved the analytical side of property. I always loved the challenges when it comes to the numbers, of planning things out and making things happen. In particular, with building and scaling a portfolio over a long period of time, finance is such a crucial part of that for any investor. And obviously for us, it was a crucial part of the success that we had in our journey, being able to navigate that. And I've always been hands-on with that. And so the opportunity of being able to do that for other people as a mortgage broker was very enticing for me. And so with that, I finally took the leap. But to be honest, starting out as a mortgage broker, I didn't actually see it as a full-time gig. With the income that we were making out of property development, I really only saw mortgage broking as something on the side, more of a supplementary source of income, and something that I could use to help create my own deals and finance my own development projects. The main aim of having my own business was to have work-life balance and be able to do something that I loved at my own pace. But a few years later, things look completely different. Today, instead of being myself operating part-time out of my own home, we're a team of 7. We're based out of an office in Eastern Sydney, and we service clients nationally. I think you can get lucky if you find something that you really love, something that you're passionate about, and also something that you're good at. And if you've got the skill set to make it happen, then you can actually generate some great results. So at this point, I pushed on. Part-time broker, part-time developer, and part-time long lunch expert. Life was good, but as luck would have it, there are more lessons down the road, and this time in the form of market cycles. The key lesson I took from taking the leap of faith was recognizing when you've outgrown your current path. But the biggest lesson of all is you can't do it alone. Finding the right team, the right people to support you, to challenge you, to grow with you, can make the difference between struggle and success. It took me years to realize that success isn't just about how hard you work, it's also about the people you surround yourself with, the mentors that guide you, the business partners that push you up, and the team members that bring their own energy and expertise to take things to the next level, beyond what you thought was possible. All the right people will make or break your journey. And today, I get to be one of those people that plays a supporting role in the success of others. I get to teach what I've learned, support others on their journey, and build a team that creates real impact. If you've made it this far, I want you to remember this. You don't need to start with money. You don't need to start with connections. You just need to start with the right mindset. And if you can stay resilient, keep learning, and surround yourself with the right people, success isn't a matter of if, it's a matter of when. And with that being said, guys, thanks very much for tuning in. I hope you enjoyed the video. Thanks very much for taking the time out to watch it. If you'd like a copy of our free comprehensive guide on buying your first investment property, feel free to download one on the link below. Otherwise, I look forward to seeing you in the next video. Thanks very much.